Have you ever noticed your mortgage paperwork has two different rates? One is your interest rate, and the other is something called the APR. Most people assume that the APR tells them which loan is the better deal. And sometimes it does, and sometimes it absolutely does not. Let me explain. APR stands for annual percentage rate. It was created to protect consumers by giving them a way to compare loan offers. It takes your interest rate and it adds many of the upfront finance charges, then it spreads those costs over the entire life of the loan to create one percentage rate. That means if two lenders offer the exact same interest rate but one charges significantly more in fees, the APR will usually be higher. That's exactly what the APR is designed to do. It's a comparison tool. But here's where people get tripped up. The APR assumes you're going to keep that exact loan for the entire loan term, 30 years on a 30-year mortgage. How many people actually do that? People move, they refinance, they pay extra towards principal, life changes. And the moment your loan doesn't last the full term, the APR no longer represents what you actually paid for that financing. Here's an example. Imagine loan A has a slightly lower APR because it spreads thousands of dollars of upfront cost over 30 years. But what if you sell the house in 5 years? Those fees didn't disappear. You paid them on day one. You simply didn't own the loan long enough for that lower APR to actually benefit you. In that situation, the loan with the higher APR but the lower upfront cost may have actually been the less expensive loan. That's why I tell my clients not to stop at the APR. Instead, ask two simple questions. What's my interest rate? How much is it costing me to get this loan? Then compare those numbers against how long you realistically expect to keep the mortgage. That's the conversation most borrowers never have. Now, am I saying ignore the APR? Absolutely not. It's one of the best tools available for comparing similar loan offers made on the same day. But it isn't designed to predict your personal cost of borrowing because it can't predict your future. It doesn't know if you'll refinance in 3 years, it doesn't know if you'll move in 7, and it doesn't know if you're planning to make extra principal payments every month. Only you know that. So here's my recommendation. Use the APR as one piece of the puzzle. Compare the interest rate and compare the total lender cost. Then have someone run the numbers based on your expected timeline, not the government's assumption that you'll keep the loan for 30 years. Because the best loan isn't always the one with the lowest APR. It's the one that costs you the least based on how you plan to use it. If you'd like us to compare multiple options based on your actual goals instead of generic assumptions, there's a link below to schedule a consultation, and we would be happy to walk you through the numbers.